Your investment account just lost $30,000 in a single week. The headlines are screaming recession. Your stomach is churning. And you're asking yourself the question that keeps every investor up at night. Should I sell everything before it gets worse? Here's what nobody tells you. The decisions you make in the next few weeks will either set you up for generational wealth or cost you hundreds of thousands of dollars you'll never get back. In the last 5 major recessions, investors who panicked and sold lost an average of 42% of their wealth. But investors who understood what was actually happening, they doubled their money within 3 years. I'm going to show you exactly what happens to every type of investment during a recession. Which ones collapse, which ones survive, and which ones actually thrive. Let's break it down. First, you need to understand what a recession actually does to the market. It's not random chaos. It follows a predictable pattern every single time. When recession fears hit in July 2026, the market doesn't crash all at once. It happens in phases. And understanding these phases is the difference between financial disaster and financial freedom. Phase 1 is denial. The market has its first big drop, maybe 10 to 15%. News anchors say it's just a correction. Everything's fine. Most investors do absolutely nothing. Then comes phase 2, panic. The market drops another 15%. Your coworker sold everything. Your brother-in-law is buying gold. The fear is contagious. This is where most people make their first massive mistake. They sell at the bottom. They lock in their losses. They tell themselves they'll buy back in when things stabilize. But here's the brutal truth. By the time things feel stable again, the market has already recovered 20 to 30% from the bottom. They've missed the entire rebound. During the 2020 recession, the market bottomed on March 23rd. Just 5 months later, it was back to all-time highs. 5 months. If you sold in panic, you missed it completely. Phase 3 is capitulation. This is the absolute bottom. When even the optimists give up. When your dad says the stock market is rigged. When everyone agrees it's going to zero. And that's exactly when smart money starts buying. Not when it feels good. When it feels terrifying. When every instinct screams to run away. Warren Buffett has a famous quote. Be fearful when others are greedy, and greedy when others are fearful. Sounds simple, but when you're watching your life savings drop 40%, it takes serious discipline. Now let's talk about what actually happens to different types of investments. Because not everything crashes the same way. Some investments get absolutely destroyed. Others barely flinch. Growth stocks and tech stocks get hit the hardest. We're talking 30 to 50% drops. Companies with no profits and sky-high valuations, they can lose 70 or 80%. In 2022, the Nasdaq dropped 33%. Individual tech stocks, even worse. Tesla down 65%. Netflix down 75%. Brutal. But here's what's interesting. Dividend-paying stocks in boring industries, they typically only drop 20 to 30%. Utilities, consumer staples, healthcare, the stuff that sounds boring at parties. Real estate investment trusts can go either way. Residential REITs usually hold up okay because people need housing. But commercial real estate, office buildings, shopping malls, they can get crushed. Bonds are supposed to be your safe haven, right? Well, it depends. Government bonds usually do fine. Corporate bonds from shaky companies, they can default completely. You lose everything. And cash loses value to inflation. But at least you're not watching your account balance crater every day. It gives you the psychological stability to think clearly and act strategically. So how long does this nightmare actually last? Here's the data from every recession since 1950. The average bear market lasts about 9 months. But the recovery time varies wildly. The 2020 crash? 2 months bottom to recovery. The 2008 financial crisis? 17 months to hit bottom. Then 4 years to fully recover. The dot-com bubble? 2.5 years down, then 5 years to break even. But here's the critical insight. If you kept investing through those downturns, if you bought more when prices were low, you didn't just break even. You crushed it. Someone who invested $10,000 right before the 2008 crash and then stopped, they waited until 2013 to break even. But someone who invested $1,000 every month through the crash, they were profitable by 2010, 3 years earlier, and their total returns by 2026, 3 times higher. Same recession, completely different outcomes. The only difference was their behavior. This is called dollar cost averaging. It's not sexy, it's not exciting, but it's the closest thing to a guaranteed wealth building strategy that exists. When prices are high, your fixed investment amount buys fewer shares. When prices crash, that same amount buys way more shares. You're automatically buying low without trying to time anything. And when the market recovers, all those extra shares you bought at discount prices, they explode in value. This is how regular people build 7-figure portfolios. Let me show you what wealthy investors actually do during recessions, because it's completely backwards from what you'd expect. First, they increase their investment rate, not decrease, increase. When everyone else is pulling money out, they're putting more money in. Stocks are on sale and are loading up. Second, they rebalance their portfolio. If stocks have dropped from 60% of their portfolio to 40%, they sell bonds and buy more stocks. They force themselves to buy low. Third, they stay invested in quality. They're not buying garbage companies just because they're cheap. They're buying excellent companies at temporary discount prices. Companies with strong balance sheets, low debt, consistent cash flow, and products people need in good times and bad times. Those are the recession survivors that come back stronger. Fourth, they keep 3 to 6 months of expenses in cash. This is their panic insurance. They know they won't need to sell investments at the worst possible time because they have a cushion. This is critical. Most people are forced to sell during recessions because they lose their job or have an emergency. If you have cash reserves, you have options. Options are power. And fifth, they completely ignore the news. They turn off CNBC. They stop checking their portfolio every day. They stick to their plan and let time do the work. Now let's talk about the 3 mistakes that will absolutely destroy your wealth during a recession. These are the killers. Avoid these and you'll be fine. Mistake number 1 is panic selling. We already covered this, but I'm saying it again because it's that important. Selling at the bottom locks in massive losses that you will never, ever recover from. Mistake number 2 is trying to time the bottom. You'll never catch it perfectly. Never. Professionals with supercomputers and PhDs can't do it. You definitely can't. Stop trying. Instead, invest consistently through the entire downturn. You'll catch some high prices and some low prices, but you'll definitely catch the recovery. That's what matters. And mistake number 3 is abandoning your plan. You spent time building an investment strategy. You diversified. You set your risk tolerance. Then the market drops and you throw it all out the window. Your plan was built for moments exactly like this. Sticking to it when it's hard is what separates people who build wealth from people who stay broke forever. So here's what you need to do right now. First, check your emergency fund. Make sure you have 3 to 6 months of expenses in cash. This is non-negotiable. Second, review your portfolio allocation. Are you actually comfortable with your risk level? If seeing a 30% drop makes you physically ill, you have too much in stocks. Adjust now, not during the panic. Third, set up automatic investments. The same amount every single month, no matter what the market does. Remove emotion from the equation completely. And if you found this valuable, smash that like button and subscribe to Operation Wealthy. We're building the ultimate library of practical money skills that actually work in the real world. Remember, recessions don't destroy wealth. They transfer it from people who panic to people who prepare, from people who react emotionally to people who act strategically. The choice is yours.